Good afternoon, everyone. Very happy to have you guys here today. Super productive Sunday, huh? Usually people sleep, eat, relax and watch movies, but kudos to AFM to bring you all here on a Sunday to actually, learn something new and, spend your time wisely. So very happy to have you guys here. But in the meanwhile, let me just introduce the topic that I'm going to talk about today. It's focused on quantitative investing. I think 3 years back or 4 years back when I started speaking to people about quant investing, I had to work very, very hard to explain what it means. I think as of today, most of you guys are aware of what quant investing really means. We've seen the journey of different quantitative mutual funds and PMSs over the last 1 to 3 years, and we know that they've done really well in terms of making superior returns and managing risk effectively as well. So I'm just going to briefly introduce the concept of quant investing, and I'm going to start with a simple example. I think everybody knows that globally there are 2 or 3 very, very large burger chains, right? We know McDonald's is there, we know Burger King is there, we know KFC is also there. Could we name even one single large burger chain in India which makes vada pav? So has any local player been able to make a pan-India brand selling vada pav successfully? That's right. That's right. So what is common between Jumbo King and McDonald's and Burger King? Anyone? What is common across all of them and the other street vendors selling vada pav? There has to be some difference. So standardization, right? Sorry? Yes. So I think the way I look at this, the big difference is that all these brands are relying on processes to support their product and not on a person to support the product, right? Usually restaurants with celebrity chefs, they do one outlet and they do a very good job at that. But the moment they try to open 10 outlets, the quality drops. And that's because they are dependent on a person to make all decisions and support the product as opposed to processes. So I think this basic difference is the difference between quant investing and traditional investing. Quant investing is marking the synergy of mathematics, finance, and technology, where the job of the humans is to make the rules and the job of the machines is to follow the rules. And that's why we call it a man with machine approach, where the man brings the wisdom, the intelligence, and the machine brings the discipline and the rigor. And the thing that we hate the most in investing is out of the picture. What is the thing we hate the most in investing? Emotions, that's right. So emotions, biases, what is all of that? Greed, fear, hope, regret, ego, FOMO, all of these are emotions which somewhere or the other drive us to make the wrong decisions. So with that context, let's dive into the world of quant, what it means in India, how it's growing, what is it doing globally, and we as PL Capital, what is the work and effort that we've put in developing this space. I think, few other panelists from my organization have already taken you guys through PL and its journey and its history. So I'm going to skip that whole section. And this is just what the market looks like right now. Everything that you guys might be hearing, reading every day. But in the world of quant, these are things we hear about, but we can't really do anything about these words. We only follow data to make us, smarter investors and guide every investment decision making. So this is what I call all the emotions, the noise, the clutter, all the stories in the market. But in quant, we have to rise above all stories, narratives, emotions, and focus purely on the data. So I think the good part for Indian investors now is that the earnings season, which was very dismal, is behind us. The valuations, which were very frothy, have corrected just a little bit. Donald Trump has come in, so the uncertainty around US elections is also sort of behind us. Maharashtra elections have been a runaway sweep for BJP, so I think that adds to the positive sentiment. The macros are moderating, but it's gradually getting factored in. Good luck for us that the festive season was good, the monsoons were good, and the rural part of the country is doing well. So hopefully the next few quarters are going to be better than the last one quarter that we have come out of. And with that, I think India should experience a bit of a relief rally. Not very sustainable, but a bit of a relief rally is expected as we're experiencing it right now as well. And in the world of quant investing, we will tell you and show you how we deal with all of this and how we differentiate the market in different phases. Sometimes we're in a bull market, sometimes we're in a bear market, sometimes we're in a correction, sometimes we're in a recovery. And in every market phase, we need a different strategy to navigate that cycle. I'm going to show you guys that as well as we go along. So let's start with some key data points to show you where we stand in India on the quant front. So to start, over the last 3 years, which is 21 to 24, the way we've seen quant grow as a percentage of all the PMS AUM in India, I think in 2021, it was just 0.14%. As we speak, it's roughly 1.2%. So I think that's roughly a 9x sort of growth in the last 3-4 years. Of course, the base is small, but the traction is increasing, the acceptance is rising, and investors now definitely want one quant fund in their portfolio. If you look at the vast gap between the traditionally managed schemes and the quantitatively managed schemes, you will understand that the bulk of the market in India is still tilted towards traditional equity strategies. We have only 25-26 quant schemes, roughly 1,000 actively managed schemes. So I think this number is going to change over the years. Not that active schemes are going to reduce, quant schemes are going to increase. I think every fund house is going to come up with their own quant offering. If you look at the AUM growth since 2021 to 24 again, I think we've seen 14x growth. So whether it's the mutual fund category or the PMS category, quant has been the fastest growing financial product in India over the last 4 years. And of course, if something is growing very fast, the reason for that also has to be very solid. And I think in case of quant, I think two things only. Investors look for only two things. One is quantum of returns. Second is risk management. If a strategy can deliver on both fronts, investors will naturally flock to that. And I think the reason for that in India is also very evident, that investors are choosing more sophisticated methods of managing money. Finally, if you look at the last 5 years data as well, on an average, quantitative schemes have delivered a 25% performance across the whole universe. But actively managed schemes have delivered 19%. And if you look at the last 1 year as well, quant managed schemes have delivered 44%, but actively managed schemes have delivered 32%. And even, I think the most surprising data is the percentage of funds outperforming in that category. So I think if you look at 5-year data, 88% of all the quantitatively managed PMS schemes have beaten the benchmark, but only 54% of the actively managed schemes have beaten the benchmark. So slowly but gradually, there is going to be wide acceptance, and this data is going to be flashed across all the wealth managers, distributors, and IFAs, and they will take slightly more sophisticated products to their investors as well. And finally, if you look at the split in the AUM as well, on the mutual fund side, again, only 14 quantitatively managed funds on the active side, 50 funds on the index side. And if you compare that with discretionary, we have 400 different schemes managed using discretionary active investing methods. And passive, of course, it's growing on a very, very massive rate, 118 schemes, and the AUM growth also has been very, very fast in India. But that growth percentage is not comparable to quant, because quant is coming from a very low base. And on the MF side also, if you look at some key data points, over the last 5 years, on an average, quant-based funds have delivered 23%. Quant-based index funds have delivered 19%. discretionary funds have delivered 18%, and passive funds have delivered 17%. So even on a medium-term basis, in the MF industry, we are seeing some sort of performance edge that quant funds are bringing to the table. If you look at the percentage of funds delivering an alpha versus benchmark, once again we see 80% of quant-based actively managed mutual funds are beating the benchmark. 50% of discretionary funds are beating the benchmark. And on the index side, of course, we don't really expect alpha because it's a passive product at the end of the day. And finally, if you look at the growth of quant also, I think it's very evident that quant is growing at a much faster pace in India. And I think this is just not even the beginning of the journey. Overall, AUM market share in India is around 1%. If I add up mutual fund, PMS, all the methods together, all the platforms together, it's roughly 1%. But globally, this number is in the 35 to 40% range. So it's evident that what Quant has done to develop markets and larger markets than India, it is going to happen in India also. And the reason is simple. Technology, talent, data, performance, and risk management. As we stand today, India has some of the best access to technology in comparison with all the global, peers. We are nowhere behind them in terms of the tech access that we have. In terms of talent, I think some of our engineering universities produce the best talent which is suitable for a field of quant investing. In terms of data, India is late to the game, but over the last 5 years now, we at least have 10 to 15 years of clean data available. In more major markets like America, I think they have clean data for 40, 50 years. So of course, they are ahead in the race, and we will get there soon as well. And finally, performance and risk management, I already gave you guys a glimpse. It's all getting on the right track. And now, with all of this background of what is quant, why is it doing well, how fast is it growing, I will throw some light on one of the funds that we manage at PL Capital, which is a 100% quant-based fund. It's called Aqua. Aqua inspired from water. I think the whole concept of water is that it can take any shape, any size, any form, and even any color. It can change all its dimensions based on the container you keep it in or based on the color you put in it. So I think in investing also, Charles Darwin has said that the only key to success in life is not your intelligence or your courage, it is your adaptability. And I think even in investing, the focus remains on adaptability, because Aqua main investment thesis is around the concept of being able to change, being able to adapt to changing market conditions. So what Aqua stands for is adaptive, quantitative, unbiased alpha. And as we go along, I'll illustrate few of these things in a little more detail as well. And the one thing we do differently within the PMS industry is we offer India's pioneering style-agnostic and style-adaptive strategy. Style-agnostic means we don't prefer growth, we don't prefer value, quality, momentum, low vol. We have no attachment or emotion to any one style over the other. We are neutral to all the styles. We like them all equally. What we do differently is, in a certain part of the market cycle, we use quality to our advantage. In a certain other part of the market cycle, we become a value-focused fund. In a third part of the cycle, we become a growth-focused fund. And in a fourth part of the cycle, we become a momentum-oriented fund. So one strategy that can change its colors, change its investment styles based on the market conditions we operate in. And I think that is the whole thesis of Aqua. And as I told you guys, that in today's day and age, we don't believe that it's a war between man and machine. It's not man versus machine, it's man with machine. Because computers on their own have no intelligence, have no wisdom. It's the humans who bring all the intelligence and teach the computers. So yes, the human must know how to mine, leverage, and use the computers to its advantage. It's not a war between the two. It's the synergies of the two which will bring you the best outcomes. And, at PL, we now, 5 years ago, when we started our journey, it was me and, one more person in the team. Now, as we stand, it's a 20-member quant team. All our quant strategies leverage and pack all the understanding of PL Group, which has been around since 1944 for the last 8 decades. So that wisdom is brought in by the group's expertise. We have 25 plus proprietary factors that we use in our quant strategies. We use 1,000 plus market indicators and have tested roughly 7,500 plus quantitative strategies to launch this one strategy, Aqua. Finally, also, the team structure that we work with, it's a very, very unique team structure. We don't have engineers alone, and neither do we have financial experts alone. Every person in our team understands something from the world of finance and something from the world of programming or technology. So assume we have a fundamental analyst who can program, an economist who can program, a CMT or a technical analyst who can program, a risk analyst who can program, a statistician who can also program. So the whole team structure is very unique compared to traditional investment strategies and traditional investment research setups. And I think a unique team structure will help you bring unique investment outcomes. You can't have the same input and expect a different output. So I think this is one thing we've done well over the last 5 years. I think as I was showing you guys over the last, since 1989, if you look at what has changed in the world, the big change is highlighted there. In 1989, 89% of the money was managed quantitatively in America. In 2023, 35% of the money is managed quantitatively. Sorry guys, my bad. In 1989, 89% of the money was managed actively in America and quant was 0. In 2023, active is down from 89 to 26 and quant is up from 0 to 35. And I think this is indicating a very, very big regime shift in a developed market like USA, and India is soon to follow. Now I will take you guys through a little bit more detail on Aqua, the strategy itself. I think the way we look at the markets, it's very simplistic view of the market across the different cycles, where we say that the markets have the bull phase, a correction phase, a bear phase, and a recovery phase. No one investment strategy or style can do well across all these different phases. If I look at bull markets, what is the bull market comprising of? In terms of fundamental styles, value as an investment style does better than quality as an investing style. Value delivers 51%, quality delivers 35% on average. As a technical style, momentum does very well. It delivered roughly 39%, and low volatility delivered roughly 30%. In terms of market cap focus, as you all would know, in bull markets, small caps would do much better and large caps would underperform. And in terms of sectors, again, data suggests cyclical sectors do very well in bull markets and non-cyclicals underperform. And all of this is compared to the benchmark, which we use, Nifty 500. Again, the idea here is, as a strategy, we cannot have an investment thesis which says, I won't invest in cyclical sectors, I won't invest in small caps, I won't invest in PSU companies, we won't invest in infra companies, real estate companies. Your starting point has to be unbiased. You can't have biases when you come to the table. You should let the market data and the market cycle dictate what is the strategy that will be most suitable in the current environment. And what Aqua does or attempts to do using data, using rules, is change the complete investment strategy based on the cycle of the market we are in. So in step 1, we just try to identify what is the macro and market cycle we are currently in. And in step 2, we decide what is the strategy we should be following. Because the moment we go into correction, our strategy will completely change colors. We will start focusing on quality and ignore value. We will start focusing on low volatility and ignore momentum. We will start tilting the portfolio towards larger caps. We will start moving the portfolio towards non-cyclical sectors. Then as we see a bear phase again, we get even more defensive. And finally, in the recovery, we have to get aggressive once again. So based on the cycle, the ability to tweak the portfolio is critical in sustainable outperformance. And again, all of this is showing you different cycles of the different factors that we use in investing. Another important highlight of Aqua is the process we really follow. It's a simple 4-step process. Again, in the first step, we try to identify which is the investment regime we're in, and we try to answer 3-4 basic questions. Question number 1, how much risk should I take in the current market environment? Should I take more risk than the market, less risk than the market, or equal to the market? Question 2, what is the investment style that I should be following? Should I be a value and momentum investor? Should I be a growth and low vol investor? Should I be a quality investor? That is the second question, which style to use when. The third question that we try to answer is, which sectors do we want to invest in? Do we want to invest in cyclical, high beta, high growth sectors, or we want to invest in non-cyclical, defensive, low beta sectors? So these questions are answered in step 1. In step 2, we quantitatively give a score to each and every listed security from the top 500 universe on different parameters such as growth, quality, valuation, momentum, volatility, liquidity, dividend, risk, sector, and theme. All of these factors are evaluated and every company gets a score. Now what we do is we eliminate 200 stocks out of the top 500 stocks based on liquidity and fundamental filters to ensure that the 300 stocks we use for evaluation, they are highly liquid and have relatively superior fundamental structures as well. And finally, we eliminate these 200 stocks and we select top 25 to 30 stocks. Once these 25 to 30 stocks are selected based on the top score, we then have to allocate to them on an equal weighted basis. Equal weighted basis is very critical because it makes sure that your risk is also divided and your returns are granular. Only if your risk is divided and your returns are well spread out can your process be repeatable in nature. Otherwise, concentrated returns from 1 or 2 stocks will usually not be repeatable into the future. And finally, on a periodic basis, we rebalance the portfolio across its market cap mix, sector mix, style mix, beta levels, just to ensure we are aligned to the market cycle. So this whole process is repeated every few months. I know my time's up. I'll just take a minute or two. Just to show you guys how we've done so far. It's been roughly 18 months since Aqua has gone live. And we divided these 18 months in 2 broad phases. Phase 1 was the bull market phase, where our strategy focused on cyclical sectors, used value momentum approaches, invested using a high beta strategy, and had a higher dominance of small and mid caps in the portfolio. So in phase 1, we delivered roughly 76% return versus benchmark BSE at 38 and Nifty 50 at 25. So we did 3x Nifty and 2x benchmark BSE 500. In phase 2, since June, our models have turned very defensive and have told us that we should now shift focus to capital preservation, alpha preservation, rather than chasing returns. So in the next phase, of which we call a consolidation phase, our strategy has done roughly 2.5% negative versus a flat market. So we've not done too well in the second phase, but I think in the bull market, we've more than created wealth for investors. In the sideways market, I think even if we just hold the capital with a 25-30 stock portfolio, we should be doing a good job for our investors. We have this strategy available for all investors on the PMS platform and also a dollar fund platform for NRIs and global investors. And I think because of time limitation, I'm going to wrap up my conversation here, but I'm happy to meet you guys offline, and my entire team is also here. So thank you so much, everyone, and I hope we can connect otherwise. Thanks.